Hi, everyone. Jim Cruzan here, and welcome to the Capital Market Review for the second quarter of 2022. If we look back at the first half of this year, there's been a lot of action. A lot of things have been happening, and none of them have been very good when it comes to the stock market or the bond market. Both seem to be in a tailspin as a result of this twin fear of inflation and a recession. Inflation brought about because of a number of issues, one of which is energy cost, commodity cost. Most of that is a result of government policy as well as the Ukraine war. We also have a huge rise in money supply. If we define it as M2, which is the sum total of all savings, cash on hand, checking account, money market, CDs, corporate and otherwise, it has increased in just 2 years, 41%. Monetarists would say inflation is too much money chasing too few goods. And as a result, it's not a surprise we have the inflationary issues we have today. And on the recession front, we've got a lot of costs that are increasing. And as a result, it has an impact on corporate profitability. On the recession front, we have a lot of inputs that are rising. And as a result, it's causing some concern as to just what profitability will look like in the future. If you think about increasing input costs as a result of commodities, wage rate costs because of inflation, and then also distribution costs because of supply chain and other issues as well, all of those things at some point will have an impact on corporate profitability. So before we get into the slides today, I wanted to once again reveal our theme for the quarter. As we do every quarter, we assign a theme that best reflects where we are today. And I would have to say it's assessing new challenges. Specifically, where are we today and kind of where do we go from here? Are we bottoming out or are things going to get a bit worse before they get a bit better? As always, we do this webinar because we believe the economy matters. And what we want to do here is dissect certain elements of the economy, things such as growth, jobs, profit, inflation, as well as where interest rates are, as a better opportunity to assess exactly where we are today. We want to know where we are, and more importantly, where we're heading. Here at Kaydan, we certainly believe that there are two things we need to get right. One is a good understanding of where we are in this economic cycle. Are we in a recession, a recovery, a mature market, or an aging market? If we're not in a recession, we're certainly flirting very close to one today. And the other thing we have to get right is, where is the Federal Reserve? Are they our friend? And are they loosening and being accommodative and keeping rates low and making sure there's plenty of liquidity in the system? Or are they somewhat our foe and they're tightening and restricting and somewhat hawkish in their approach? One would have to say that today they certainly are much more hawkish and restrictive than being accommodative. And it will more than likely get worse before it gets better. These two things are very important because understanding both will give us a better idea as to how to orchestrate a portfolio. Where do we put weightings on? What amount of equity do we want? Or how little do we want to carry? Do we want large cap versus small, US versus international, growth versus value? All of these components can be driven by both where we are in terms of the economy, as well as what our understanding of the Fed is. Today's agenda is short. We're going to talk essentially about three things. First, we'll address the pace of the recovery, followed by monetary policy. We can't have a discussion about the economy without talking about monetary policy. And then we'll talk about risks as well as opportunities. We will go over just simply 10 slides, and these 10 slides will best frame where we are today and what the concerns are that we're looking at presently. So let's get right into this, and let's talk about the pace of the recovery. This first chart talks about economic growth of GDP. And you'll see the trend line, which is that dashed blue line, kind of running in a 45-degree angle from left to right. That's 2% growth. That has been historically our GDP growth trend line. And you'll see for many years prior to COVID, we were tracking somewhat less than 2%. That was an anemic growth rate. And there have been other periods of time, let's say coming off of the dot-com bubble crash, where we were effectively tracking much higher than that. If we look to the far right on that chart, you'll see the huge V shape, the huge drop in GDP activity because of COVID, essentially reducing our GDP activity by a full 8% was huge. And then the incredibly large recovery that we had immediately following. That turned out to be one of the shortest recessions we've ever had in history. To the point where at the end of last year, our GDP was actually much higher, measurably higher than it was before going into COVID. And then at the very end, you'll see the little hook, the little bit of a drop that we're seeing today. Now, why are we experiencing a drop in GDP? One of the biggest reasons currently, might not be the total reason, but certainly right now, it probably has to do with government spending. If you think about the huge amount of government spending that we had to get us out of the COVID issue, in fact, money supply, M2, increased, as I said, 41%. Today, the expectation for this year is our deficit, which is the amount of money we overspend, taking into consideration all of our tax revenues, all of our fees that are collected, minus whatever the government spends on entitlements, military, et cetera. We run about a 14% deficit. This year, that deficit should actually close to about 4%, a huge reduction in a single year. The reason? Less government payments. They're no longer our stimulus checks. They're no longer our enhanced unemployment benefits, enhanced child care credits, and so on and so forth. As a result, there isn't anywhere near the amount of cash flow or liquidity we had before. Add to that the fact that we're starting to see quantitative tightening, where the government is now selling bonds. That is also reducing some cash that we have in the economy. We'll see exactly what happens in the future and how this progresses. More than likely, economic growth will also be compromised because of company profitability, and we'll see what companies do at that point. It's a little bit more difficult in such a tight job market. Another thing that we have to look at is wages and unemployment. In fact, this chart looks almost like a mirror image of the other. The black or gray line, I guess, is unemployment, and the blue line is wage growth rates. And you'll see that because of COVID, unemployment peaked at about 14.7%. And today it's at about 3.6. That 3.6 is just a hair higher, about 0.1%, higher than it was in 2019, where we enjoyed a 3.5% unemployment rate. So effectively, we're almost back to where we were before. At the same time, however, we're seeing about a 6.5% increase in average wages year over year. I don't think that's going to change anytime soon. Currently, the country has 5.5 million unfilled jobs. More than likely, a higher degree of wage cost will be factored into the economy for an extended period of time. When we look at CPI and core CPI, inflation, we'll see that that has also spiked this year. In fact, that's one of the problems with the market and what the market is facing currently. At the end of June, or I should say at the end of May, that unemployment rate was, or I'm sorry, the CPI was about 8.5%. Currently, it just measured at over 9. This also is somewhat sticky. Everybody is waiting for the moment when they can say that inflation is actually peaked. We thought it would be this last print, but it was actually worse than the print before. Now they're saying, that's it, this is as high as it's going to be, and things will get better from here. As I see it, it's not an issue of when it peaks. The issue is how quickly it comes down. And I think the longer we deal with inflation, the longer we deal with components that affect inflation, the stickier the problem becomes. As a result, the Fed may have to continue raising rates longer than the market is anticipating. More on that in a little bit. If we look at profitability, we'll see that even this year, at least at the beginning of the year, the expectation was corporate profits, as based on the S&P 500 earnings per share numbers. The expectation was profits would increase by about 8% this year. And most of that is as a result of increase in revenue. You'll see that last year, profits increased by nearly 70%. And again, we can understand why by looking at the year before, which would have been the result of COVID. But here's the interesting thing. Profits, or an expectation of an 8% growth rate, was also measured and calculated and anticipated before some of the issues we've had currently so far this year. I would certainly expect that when you look at input cost, wage cost, distribution cost, etc., we may very well see those numbers come down. To date, there have been very few analysts that have cut numbers. We're right on the cusp of the earnings reporting period, and more than likely, as we move through that period, some of these expectations will be adjusted, more than likely downward. Now, looking at the global economy, we're looking at a heat map. And this heat map, all you need to know is green is good and red is bad. And it's talking about the PMI numbers, or the Purchase Managers Report. Generally, a number of 50 or more indicates an expanding economy. 50.1 indicates the economy is still expanding. Anything below 50 indicates contraction. Now, if we look at this chart and we look at probably 2/3 of the way through the page, look at 2019-20, you'll notice that most everything was quite red. Again, red being bad, slowdown, recession. And since then, things have improved quite a bit. That said, there are still certain areas that are somewhat problematic. We notice that the emerging markets are certainly weak. You'll also see China being quite weak. China is weak in part because of their zero COVID policy. And that's also impacting manufacturing and also impacting supply chain. So we're not completely out of the woods. If anything, this would suggest, also, by the way, if we were to look at some of the Eastern European countries, you might very well notice that those numbers are maybe not quite as green as some of the other numbers we'll see. Look at Russia as an example. Obviously, that has everything to do with the Ukraine war. If anything, this does not suggest that we're on the cusp of a global recession, but it certainly suggests that whatever the global recovery is, it's probably going to be slower and take a bit more time than anticipated. Let's turn for a minute on monetary policy. I've shown you this chart every quarter for a number of years now. And really, for the most part, the chart doesn't change because it's a historic review of where interest rates were. So with respect to this chart, the first 90% of it looks very, very similar to years gone by. The real action is at the very end of the chart. Now, if we consider this chart today as it looks currently, and just simply review what a chart would have looked like from a year or so ago, there's a huge change. Specifically, if we looked at a chart from a year or so ago and looked at where the thought was that we would be with respect to interest rates in 2022, that line would look to a large degree like a continuation of that flat line that we saw from 20 to currently 22 before it started moving kind of parabolic. In fact, the line is almost vertical. There was no thought of that a year or year and a half ago. But now we see this huge increase in interest rates as a result of the Fed's hawkish stance. Now let's look at the the broken lines, the dotted lines. And you'll see both an expectation of where things are going in the future. The blue set of dots are the FOMC year-end estimates. This is the estimate of the Federal Open Market Committee. A lot of federal bank presidents giving their 2 cents on where they think interest rates will be. And you'll see the Fed is prepared, or I should say, Fed presidents are prepared to anticipate that rates will continue to rise through 2022 and into and through 2023. The green line is market expectations. This is how the bond markets are priced today. And what they're expecting is that the Fed starts cutting rates as soon as late this year or very early first quarter next year. The hope or thought is the Fed will not tolerate a recession and will come to the market's recovery. And that's being priced in to a large degree currently. I think if you listen to Chairman Powell and listen to his comments after a presser, he's been very clear. They're willing to risk a recession to get inflation under control. So I think at some point, there's going to be a shift off of somebody's page onto somebody else's page. And this may cause some consternation in the market as the market comes to grips with the fact that the Fed may very well be raising rates a bit longer, or more importantly, maybe even raising rates much higher than anticipated. Because of rising interest rates, it's had an effect on many asset classes, most definitely fixed income and bonds. And this is just an outright ugly chart. It shows basically that there's no place to hide in bond land. In fact, if you look at the first set of boxes to the left and look about the fourth column over, all red all the way down, that's where bonds were year to date total return. And it depends on the type of bond we have. Treasuries from 2-year bonds to 30-year bonds, the US aggregate bond index, corporates, govies, convertibles, you'll see they're all down and down pretty appreciably, except for very short duration bonds, which are like money market. And yet those are still down as well. So there's been no place to hide in bond land. And that has its own set of ramifications. And those that are most painfully hurt are probably those that have a more conservative stance to their portfolio, which should be anybody that is somewhat aging, anybody that's fairly close to retirement, or anybody that is in retirement, and especially those in retirement and are under distribution. You're taking money from your account to provide for your lifestyle. You're taking money out of your account because of required minimum distributions or such. Anytime you're under distribution, you want to have a bit more conservative bias. A traditional 60-40 or balanced portfolio has always been kind of the gold standard. We can see, based on bond performance, that gold standard this year has certainly failed us. Folks that have a portfolio with 40% or more in traditional bonds, depending on the allocation, are seeing losses this year that are every bit as painful as what the stock side of the equation is doing. No longer are we getting protection on half the portfolio to offset some of the loss on the other half. Again, this is a phenomenon that is somewhat unique to this year because of the inflation effects that we're seeing. The fact that this year we have higher inflation than we've seen in 40 years. This year, we're seeing a Fed take aggressive action. And as a result, this year, we're seeing the bond market take losses that we probably haven't seen in a single year, certainly not in the first 6 months of the year, in, let's say, the last 50 years. Again, look at it more as an anomaly. Rates will come down, bond values will go up, especially when there's some expectation that the Fed has inflation under control. That said, doesn't look like it's going to happen anytime real soon. But again, All of this is data dependent, and it can change pretty quickly. Let's turn for a second away from bonds and let's look at equities. So this chart talks about S&P 500 valuations, or as we refer to them as PE, price earnings multiples. And if we look at the very end, the last part, the far right of the chart, you'll see at the peak of that gray line, which was, let's say, end of last year, we had a price earnings multiple that was something north of 22 times earnings, or people were willing to pay $22 for every dollar of earnings a company had. And that number, 22 times earnings, was very close to 2 standard deviations removed from the 25-year average. Fairly lofty PEs. And considering that, and looking at the chart in total, you'll see that we didn't have PE valuations anything close to that, except 20 some years ago, leading up to the dot-com bubble. So things were really quite pricey. And now that the market has dropped a bit, we're beginning to see PEs, at least as of June, of something closer to 16 times earnings, which is actually just a hair below the 25-year average, which is encouraging. Theoretically, when you are buying securities at a high PE, because price matters, forward-looking return assumptions become weak or are less. And when you buy securities at a lower PE, especially historic low PEs, forward-looking return assumptions are much more significant, much more favorable. Here's the problem with the chart. The PE ratio that is being used is still being used off of an earnings estimate from last December. In fact, as I said before, many of the analysts that are out there haven't really dumbed down earnings estimates. They haven't actually factored in the effect of input cost, inflation, higher interest rates, supply chain at all against the bulk of corporate America. And as we enter into and get through earnings season this year, we may very well see those estimates come down. And if those estimates come down, so PE, if the E comes down, then all of a sudden that same ratio, which today looks not so bad, may once again look ridiculously expensive at these valuations. And as a result, that might be the next shoe to drop, the last shoe to drop. And then at that point, there's a chance to really build a floor, a basis, and then see a recovery start. But until we have a better understanding and better clarity on earnings, we don't see that happening just yet. Now, taking a look outside of the S&P and looking at other asset classes, let's take a look at this chart. This is a Callan chart. Every single square represents a different type of asset category. We have equities, small and large, international. We have fixed income, real estate, etc. And if you look at the chart from afar, you'll see that there's a lot of movement. A particular asset class may perform poorly one year and do very well the next. One might perform very well one year and is horrible performer the next. We see that just year over year. When we consider large cap being the second best performer in 2021 and second from the bottom this year. And in 2020, small cap was the best performer. Year to date, it's the worst. The takeaway on this is, look, nobody's got a crystal ball. So what we try to do is diffuse and reduce some risk. And we do that by building balanced portfolios. A portfolio that has stocks and bonds and US and international, large and small. And JP Morgan doesn't have a fund that does this, but they have a model. And that model is that light gray area. And you'll notice that with that light gray area, you will see the kind of returns that would have been expected off of that type of portfolio if it actually existed. Again, before any internal fees, management fees, it's not a real index, but just the same, it gives you a general idea. And even today, with the markets down 20+% as of June, technology stocks down mid 30s, an allocated portfolio would have been down just under 15, which is actually quite a bit better than being down somewhere between 20 and 35. That said, most of our large IRAs are being run under a model that we create, which we call our dynamic global balanced account. We run synthetic stop losses. We run other things in there to help reduce downside risk. Through the end of June, the model was down 9 and some change, significantly outperforming a balanced account. And we hope that it'll continue to provide that kind of downside support, in spite of the fact that things might get a bit weaker before they get better. One last slide to share with you, and that is consumer confidence. And this is kind of an interesting slide, and it can be kind of counterintuitive. It can also be somewhat of a leading indicator for future performance. So if we look at, again, near the end of the chart, probably 90% through it, you'll see February 2020. That's when consumer confidence was as high as it's been recently. And it was 29%. Don't need to worry about the percentages, just understand that it was really quite high. That was just before COVID. And then we saw a substantial drop in consumer confidence when COVID hit, not a huge surprise. And then we saw an immediate reversal. It climbed back up a bit. And it did that when we were looking past COVID toward the late summer, early fall, and colder weather of 2020. And then we got hit with a number of other COVID iterations and things dropped again. And then at the beginning of this year, or shortly after the beginning of this year, Ukraine war, inflation, supply chain, on and on and on, we've seen it drop even further. So today, it's quite a bit lower than it was back in February of 2020. Now, are we at the low point? It's quite low compared to the chart of recent years, and it's historically similar to other low points. But have we actually, at this point, looked beyond all the other crudiness that could come about over the course of the next couple of months as rate hikes and quantitative tightening actually start to affect corporate profitability? I'm not sure. But the big takeaway on this is generally when consumer confidence is really high and you look at performance of the market over the course of the next 12 months, it's not all that great. It's only about 4.1% on average over the, on average, looking at the last 8 peaks in consumer confidence. Conversely, when consumer confidence bottoms out and it doesn't get any worse than it is at that time, the next 12 months usually produces returns that are well in excess of 4. In fact, they're more like 30%. So hope springs eternal. When this thing turns around and things look as gloomy as they possibly can, there's better performance days ahead. I don't quite think we're there yet. I don't think we've seen capitulation. I kind of know what that feels like, and I haven't had those panic calls. I haven't had people who said, get me out no matter what. People who don't want to talk about the market. The fact that everybody's talking about, have we seen capitulation or not? And there's a high degree of liquidity in the system. I don't think we're quite there yet. But we're having these conversations and we're prepared for that. So again, why do we do this? Because we think it's important to understand where we are in the economic cycle. And it's also important to understand the Fed because it does have an impact. Let me share with you this slide, which I've shared with you, I think, last quarter. This is a tool that we use from ClearBridge Investments, and it helps us better gauge the type of risk that we should be carrying in our portfolios. And what it does is it looks at these 12 key component indicators. It will assign a grade to those based on whether it's helping or hurting the economy, assigns a color to that, red, yellow, green. Prevailing color determines the overall signal. If the overall signal is green, it means there's a very low probability we'll see a recession inside of the next 12 months. A lot of analysts concur that we'll probably see a recession sometime next year into the end of the first quarter, early second quarter. So that's fairly close to a year. If the prevailing color is yellow, high probability of recession inside of 8 months. And if it's red, high probability inside of 3 months. The way we use this is really more of rate of change. As an example, if we were to go back to October of last year, all 12 were green. Between October and November, one of the greens turned yellow. Between November and December, another green turned yellow and that yellow turned red. And that was exactly the way things stood December, January, February, and March. You'll see 10 green, 1 yellow, 1 red. And then since then, you've seen this thing progressively get weaker. And we've seen sizable change just over the last month from May to June. If you look at your IRA, especially those IRAs that are being managed under a dynamic global balanced account, and you notice our net exposure to the market and the amount of cash that we're sitting on, and just go and compare that to where we were in October of last year, when everything was good to go, you'll see we are and have been for quite some time reducing risk exposure. And we do that because the economy will go through its cycle, but the market goes through its own cycle, and that cycle tends to be a little bit in advance of the economy. And it will front run the economy a good 3 to 6 months. So we want to notice this ahead of time so we can react. If we wait until we realize we're in a recession to then worry about getting defensive, it's way too late. Also, what's interesting is those green boxes on the top of the chart. If you look at the blue S-curve, which is the economy, those green boxes relate to the blue S-curve. And it kind of shows the areas that we sort of want to be in depending on where we are in the economic cycle. For example, in 2020, height of the COVID problem, tech did terrifically well. And if you look at where we are in full recession here at the bottom of the blue S-curve, and then look at the green boxes above, you'll see, gee, tech, industrials, cyclicals, those are the ones that did really well. And now today, if you look at the peak of the blue S-curve, that would be full recovery. We know we're somewhere to the right of that. Maybe not yet recession, maybe early recession, maybe not yet early recession. But what works well there? Healthcare, utilities, finance, all the value stocks. And if you look closely at your IRA, you'll notice we moved out of growth late last year, last third, fourth quarter of last year, and have been value ever since. That has also helped with a lot of our downside protection. So with that said, I want to thank you for listening. Undoubtedly, you have friends, family, other people you care about who might have questions about the market. Maybe they're facing retirement. Maybe there's a lump sum versus pension question. We would love to be able to provide a second opinion to those same folks. We would love to be able to take them through our evolutionary wealth cycle and hopefully allow them the ability to get the answers they need to be able to make smart decisions about their financial future. As always, we're interested in hearing from you. If you have any questions, please reach out by phone or simply reach out via our website. That said, thank you much. Enjoy the summer. And we'll look forward to doing this again in October. Take care, be safe, and stay healthy.